Question number 12. An asset's book value is $19,100 on December 31st of year 5. The asset has been depreciated at an annual rate of $4,100 on the straight line method, assuming the asset is sold on December 31st of year 5 for $16,100. The company should record what? Well, you always compare how much you sell something for. In this case, the selling price is $16,100 to what the book value is at the time that you sell it. And at the time that we sold it, the book value was $19,100. So the book value is $19,100, the selling price is $16,100. Therefore, you're going to record a $3,000 loss because the book value was more than what you sold it for. Number 13. An asset's book value is $64,800 on January the 1st of year 6. The asset is being depreciated $900 per month using the straight line method. Assuming that the asset is sold on July 1st of year 7 for $46,600, the company should record what? Well, the first thing you should do is you should bring the book value of this asset forward to the point of sale, that is July 1st, year 7. And if it had $64,800 on January 1st of year 6, then you've got to bring it forward another $900 per month until you get to July 1st of year 7, and then compare the book value then at that point to the $46,600 that you got. So if the asset's book value is $64,800 on January the 1st, like it was in year 6, and it's being depreciated for $900 a month, then you've got 18 months involved there, or another $16,200 worth of depreciation you need to add on. So when you get to July 1st, year 7, the asset's book value on the date of sale would be $48,600, and if you sold it for $46,600, then you're going to take a $2,000 loss. Question number 14. A company sold equipment that originally cost $280,000 for $140,000 cash. The accumulated depreciation on the equipment was $140,000. The company should recognize a what? Well, the cost of the equipment is $280,000. The accumulated depreciation is $140,000. So therefore, the difference between these two would be the book value of $140,000. So you compare the book value at the time of sale to how much you received at the time of sale, which was $140,000. And in this case, you're going to have no gain or no loss, so you don't record any thing as far as a gain or a loss on this. Number 15. A company discarded a computer system originally purchased for $8,650. The accumulated depreciation was $6,550. The company should recognize what? Well, if the cost of the system was $8,650 and we depreciated $6,550, then we have a book value of $2,100. If we discarded this computer system, threw it away, then that means that we received no cash. Therefore, we have a loss of $2,100. Number 16. A company had a tractor destroyed by fire. The tractor originally cost $127,000 with accumulated depreciation of $61,800. The proceeds from the insurance company were $91,000. The company should recognize what? Well, let's see. The cost of the tractor was $127,000 minus the depreciation of $61,800. That means the book value is $65,200. If you received $91,000 cash, then looks like we have a little book, I guess it's a typo or a error in the key, because if you received more money than the book value, then you're going to have a gain of $25,000. Let's see, does that come out to be $25,000? Yeah, $25,800, not a loss. So there is a, looks like a key error there. All right. Question number 17. A company's had a fixed interest rate expense. Let's start this again. Question number 17. A company had fixed interest expense of $4,800. Its income before interest expense and income taxes is $17,200 and its net income is $7,600. The company's times interest earned ratio equals what? Well, times interest earned ratio is a ratio that the bank uses, and they try to see how many times you can make your interest payment. The bank likes to see this ratio as high as possible. So let's see what this company's ratio would be. So a company has fixed interest charges of $4,800. Its income before interest and taxes and is going to be $17,200. So you're going to take the $4,800 and you're going to divide it by the $17,200, and let's see what that comes out to be. So when you take the $17,200 and divide it by $4,800, the answer that I got was 3.58333 forever, which means they could make that interest payment 3.5 times. And the higher that ratio is, the better it is. Let's look at another one of these. Question number 18. A company's income before interest expense and income taxes is $275,000. Its interest expense is $85,000, and its times interest ratio would be the income before interest expense and income taxes of $275 divided by the $85,000 interest expense, and that's going to be a 3.24 times ratio. Again, higher is better. Question 19, the same kind of thing. A company's fixed interest is going to be $23,000, and its income before interest expense and income taxes is $178,250. Its net income is $80,200, which you can ignore that. The company's times interest earned ratio equals what? It'll be the income before interest, expense, and income taxes, and that was given to you of $178,250 divided by the interest expense of $23,000, and this time the ratio is 7.75 to 1. Question number 20. On December the 1st, Victoria Company signed a 90-day 8% notes payable with a face value of $6,600. What amount of interest expense is accrued at December 31st on the note? Accrued means that you want to pay interest for the from the month of December, which is December 1st through December 31st, and that'll be 30 days, and we're going to go $6,600 principal times interest rate of 8% times 30 days, which would be that December 1st through December 31st, over 360, and when you multiply all that out, that comes to $44 interest. Question 21. On November the 1st, Allen Company signed a 120-day 8% note payable with a face value of $17,100. What is the adjusting entry for the accrued interest at December 31st on the note? Well, again, we're trying to show that we owe this interest. We're not going to pay it yet. We're not going to pay it until the due date, which is 120 days from now. That is 120 days from November the 1st. But we're going to accrue interest from November the 1st to December 31st. So the interest is going to be calculated as follows. It's the principal, which in this case would be $17,100, times the interest rate of 8% times 60 days. That is November the 1st to December 31st, 60 days over 360, and we're always going to use a fiscal year, which is 360 days. And this comes out to interest expense that we owe on this note as of December 31st from the November the 1st of $228. And the way you'd record that on your books is you would debit interest expense for $228 and you would credit interest payable of $228. Question 22. On November the 1st, Allen Company signed a 120-day 12% note payable with a face value of $15,300. What is the maturity value of the note on March the 1st using 360 days in a year? All right, the maturity value will be the interest and the principal, and the interest is going to be based on from November the 1st all the way to March the 1st. So we're going to take the principal of $15,300 times the interest rate of 12%, times 120 days, that's from November the 1st to March the 1st, over 360, put all that in your calculator, and you should get $612. So the maturity value will be the principal of $15,300 plus the interest of $612, or the total will be, for the maturity value, $15,912. Question number 23. On November the 1st, Allen Company signed a 120-day 10% note payable with a face value of $69,000. Allen made the appropriate year-end accrual. Now, we've been doing that for the past two problems. We're trying to find out now, what is the journal entry on March the 1st to record the payment of the note, assuming no reversing entries were made. Okay, now remember, previously, what it said right here is we made an adjusting entry to accrue interest from November the 1st to December 31st. But the note is 120 days, which means the note is not going to be due until March the 1st, which means we now have to, on March the 1st, pay the note and all of the interest, and then show how that affects the previous entry we made to accrue that interest on December 31st. So let's do this. The principal of the note was $69,000. The interest rate was 10%, and the time period from the last day of the year, or the first day of the new year, January the 1st to March the 1st, is 60 days. So the interest in the new year is going to be calculated as $69,000 times 10% times 60 over 360, or the interest expense that's on the current year will be $1,150. The interest expense, let's see here, yeah, we've already done all that, $1,150. So I'm sorry, the 60 days of the previous year, which was November the 1st to December 31st, that's another 60 days, which will accrue interest on there. $69,000, 10%, 60 over 360, interest payable of $1,150, and the maturity value of this note is going to be the principal plus all of the interest, which would be for the whole, looks like 120 days, 60 days before the old year, and 60 days of the new year into the new year. And so the total interest will be the $1,150 plus $1,150, or $2,300, plus the principal, or the total is going to be $71,300. Now, we are going to make the following entry on March the 1st. That was all the calculations. We're going to take in all of the cash, which is $71,300. So we're going to pay out all the cash of $71,300, which would be credit to cash for $71,300. We're going to get rid of the notes payable for $69,000. We're going to debit interest payable for $1,150. That's the interest that we paid for the time period from November the 1st to December 31st. And that gets rid of all that old interest. And then we're also going to show interest expense in the new year, that is from January the 1st to March the 1st, that's those 60 days, with a debit to interest expense for $1,150 there. So to recap this, we're going to take the old note off the books. This note is now paid, so we're going to take it off the books. We're also going to take off the interest payable that we'd set up in December 31st off the books, because it's going to be paid with the payout of this cash. And we're going to set up this new interest expense from January the 1st to March the 1st for $1,150. And we're going to credit cash for $71,300.